Hello, everybody. Charlie Gipple here. I bet if you're a financial professional that you know of a lot of clients that have a big proportion of their money in pre-tax retirement accounts. And what am I talking about with pre-tax retirement accounts? I'm talking about traditional IRAs, traditional 401ks, maybe 403b plans, maybe 457 plans. What's the problem with that pre-tax money? Well, as we all know, and as David McKnight says, is there's a problem there, and that problem is that you are in partnership with the United States government. You see, different than a partnership that, say, you and I would create if we were to create a LLC, for instance. You see, the way that an LLC is created is we would have some sort of an agreement set up, an operating agreement, and I, for the most part, can never unilaterally just say, yeah, you know what? We've been in this business for 5 years and I've owned 50%. But you know what? I think today, because I'm kind of in the mood of owning 75% of this company, I think I want a little more of the company. No, typically certain legal hoops have to be jumped through at that point in time, right? That is different than going into partnership with the United States government when it comes to that pre-tax money. And that is exactly what you are doing with that business of a traditional IRA, traditional 401k. You are going into partnership with the United States government, and the United States government can increase their share anytime that they want. So even though it may be acceptable today to say, yeah, I'm fine with the US government owning, say, 35% of my business being called the traditional IRA, you may not be comfortable with the fact that the United States government can unilaterally increase their share in that business called the traditional IRA, traditional 401k. Now, historically, how large of a share has the United States government from an income tax purpose? From an income tax standpoint, how large of a share has the United States government had when we look at income taxes, specifically the highest marginal tax rate? So over the last 107-year period of time, since 1913, when the income tax was created, you have the median, you have the average, and then you have today's. The lower blue line there is today's highest marginal tax bracket, 37%. If you look at the average over that 107-year period of time, well, typically, based off that average, the government has had, well, about 57% of that share, right? Or 57% share of that business, so to speak, to simplify it. The median, which is different than the average for those non-statisticians listening to that, the median is the midpoint over the last 113-year period of time. So what would that be? It'd be the 56th, 57th year. What is that midpoint? 63%. The point of this slide is today is the anomaly. We have been spoiled by low tax rates, and when tax rates increase, when the United States government, should they increase their share, that may be merely just going back to normalcy, right? Now, the goal here to accumulating wealth, it's fairly simple. The concept is fairly simple. You put in the green amount, you get back the blue amount. So whether it's tax deferred money, the goal, it's simple, and it's the same whether it's tax deferred or tax free, being cash value life insurance, Roth IRAs. Because on the right hand side, again, you put in the green amount, hopefully get back the green and the blue amount. On the left hand side, people may feel warm and fuzzy at first because they put in money that has not been taxed. If you made $100,000 in a certain year and you put $5,000 into a traditional IRA, well, from a tax standpoint, you are only going to be taxed on $95,000 in that year, again, to simplify. Conversely, on the right-hand side, when you put money in, that money has been taxed, right? But what have you done by paying taxes on that money? You have excluded the government by having any portion of your business called the traditional IRA, traditional 401k. Because here's the thing, is when you take out that green and the blue on the left-hand side, that is all taxable, right? When you take out the blue and the green on the right-hand side, that is tax-free. As I like to say, and many in the industry like to say, would you rather pay taxes on the seed or would you rather pay taxes on the harvest? Because on the right, you're paying taxes on the seed. On the left, you are paying taxes on the harvest. Now, the main determinant of which way you go, whether it's the left or the right, is where you believe tax rates are going to be when you retire. When that business is sold off, for instance, 20 years from now, do you think the government is going to have a larger share of your 401k or traditional IRA than where we are today? If you believe that tax rates are going to increase between now and then you may be better off choosing the right-hand side of this equation. Again, Charlie Gipple with CG Financial Group. Some of this material I have, you can contact me and I'll share it with you. Have a good day.